Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. China's real estate crisis continued to spread this week as investors grew more and more concerned about the state of the debt of China's real estate developers. Well, we talked last week about those real estate developers that were once considered investment grade, like Shimao, that were once considered safe. The crisis spread this week to China's largest real estate developer. So we're going to shake things up a little bit this week by skipping Evergrande.
You know, everybody's laughing, but that's okay.
As there wasn't a whole lot of news about the real estate developer, except for that it had transferred some projects to its creditors as a means of payment. So today I want to go over how the crisis has spread to China's largest real estate developer, Country Garden. Then I want to move on to an update of China's overall economy, as the real estate crisis has definitely spread throughout and it's putting a real strain on China's economic growth. And then we'll take a look at some steps that China has taken this week and is considering taking to help slow down the real estate crisis, which are almost the exact opposite steps that the West, that the United States, that Canada is currently taking to slow down our economy. They have almost the exact opposite problem that we do. Chinese real estate developers have over $99 billion in debt coming due this year, so it definitely looks like it's going to be an eventful 2022. And of course, we'll have our Friday weekly updates on the Chinese real estate crisis. We're also eagerly awaiting the Bank of Canada's interest rate announcement set to come out next Wednesday, as more and more banks, more and more commentators are calling on the bank to raise interest rates. Click like and subscribe if you want to get all those updates, but for right now, let's get into Country Garden. Country Garden, China's largest real estate developer, began to wobble a bit this week as the crisis continued to spread throughout the real estate market. The developer
has more than 3,000 development projects in almost every single province in China.
The developer saw its stocks tumble this week as it failed to garner any interest in a $300 million bond that it was offering. So the developer offered to issue $300 million in new debt and nobody wanted it.
I don't want it.
Which gives us a pretty strong signal of what investors, of what the market thinks of current debt being issued by Chinese real estate developers. Well, no one wanting to purchase the largest real estate developer's debt is a problem in and of itself, especially since it was a credit crunch that really started this whole crisis with Evergrande. It's really a problem going forward.
So any trouble at Country Garden is going to reverberate across the economy and across society. So that's why this is a big concern.
I mean, yeah, definitely. If investors in the market are worried about the developer with the largest amount of sales in China, the largest real estate developer in China, which currently employs over 200,000 people, then that could have a real negative impact on the overall Chinese economy. And as we talked about before, when China sneezes, the world will feel it as being the second largest economy in the world. We've already seen major slowdowns in the Chinese economy, which we're about to talk about, due in large part to the real estate crisis.
What about me?
Yeah, you too. But also definitely the real estate crisis, as it represents such a large portion of the Chinese economy, around 30%, which we've talked about in other videos. Speaking of the overall Chinese economy, data came out for the fourth quarter of China's GDP this week, and it showed that China's growth had slowed to 4%.
I mean, even at 4%, this is still a very sort of a weak number overall compared to history. And in the first half, we're looking for growth to continue to be weighed down, in particular by the property sector, and of course, this zero COVID policy. I
mean, yeah, with China growing at nearly 10% year over year for the past 30 years even, a slowdown to 4% is a major economic slowdown for China. Though the country had an annual growth rate of 8.1%, as we talked about last week, that is an annualized growth rate, and we had a very much backloaded real estate crisis in China that started around August, which really brought the overall GDP numbers down. So I think the first half of the year really propped up the yearly GDP numbers, and the second half of the year really slowed it down, as we see at 4% growth rate. Overall 8.1%, but if this real estate crisis continues, and by all accounts it's looking like it's going to, we could see a continual major slowdown in China. Not to mention Omicron, but yeah, things aren't really looking that great right now for the Chinese economy.
Really bad.
So as a result of the slowdown and the real estate crisis, and of course Omicron, multiple Chinese provinces have begun to slow down, to revise their projections for GDP growth going into 2022.
It happens.
sometimes you just can't get there.
So I think even the local governments in China see that the writing's on the wall. The days of 10% year-over-year growth are probably coming to an end, and we really don't know how much this is going to slow down going forward. With all of that said, Beijing is taking steps to help prop up this economy, opening up its wallet and cutting interest rates for the first time since April of 2020. In addition to cutting interest rates, China is also expected to look to cut its reserve ratio requirements. That's the amount of money that banks have to keep on hand compared to how much money they lend out. So the lower those requirements are, the more risky that bank will be, as they'll have way more money in the system than they can actually back up with cash reserves on hand. So we've already talked about in previous videos that the reserve ratios have already been cut, and it looks like they're looking at cutting them once again. In addition to cutting interest rates and cutting the reserve ratio requirements, China is also looking into easing some of the credit restrictions that caused this crisis in the first place. So we can see that China's really looking into getting more money in the system. They instituted this 3 red lines policy last year, and many are attributing it to really causing this overall credit crisis, as developers have been unable to access cash. Although China's stocks rose on news that they would be easing their credit requirements, bonds quickly fell thereafter as investors grew increasingly wary that the easing of this credit crunch would actually help real estate developers.
Well, what's in it for me?
So overall, China is kind of having the exact opposite problem that we're having in the West, that we're having in the US, and that we're having in Canada. Where in the US and Canada, our inflation rate has hit 4.8% Canada, 7% in the US. We're looking to take money out of the system. We're looking to slow the economy down. Meanwhile, in China, they are currently in a slowdown, and they need to speed it back up. So they're getting money into the system in much the same way that we did in March of 2020. They're slashing interest rates. They're making it easier to get credit, and they're lowering the restrictions on the banks. Much in the same way that we did. So we really see these two opposite problems happening on both sides of the world. And like we've talked about before, when the Chinese economy slows down, it's going to actually hurt what we're trying to do in the West. In the West, we're fighting this inflation rate, but a slowing down Chinese economy is going to make it more and more expensive for us to purchase goods, as they are currently also undergoing multiple lockdowns due to their zero COVID policy, and their real estate developers, which represent, as we said, over 30% of the economy, are struggling. We're going to see a real slowdown in China if these new policies don't work as intended. As those policies continue to slow down the Chinese economy, it's just going to make what we're doing even more difficult. With all of that said, we still don't know what the effects of these lowering of the interest rates are going to have on the Chinese economy. Once you lose investor confidence, once international investors start to worry about the safety of their bonds, of their money, as we saw with Country Garden not being able to sell even $300 million worth of debt, which is nothing.
It's nothing. What are you going to do with that?
Compared to the $99 billion coming due in 2022. Once you start to lose the confidence of international investors, and especially if you lose the confidence of domestic investors, it's extremely difficult to get it back. And if you do get it back, there is a major price premium. If investors are going to invest in China, they were going to want to get a premium on those investments in order to get their money back, in order to make it worth it for them to take a risk. And if interest rates are that high when the Chinese economy is trying to rebound, it's going to make it even more difficult for that rebound to gain speed, which is why China is trying to make money as cheap as possible on the domestic front from the government. So no one knows quite yet how this crisis is going to play out, but like we said, we will have our updates on this channel every Friday. Make sure you click like and subscribe if you want to get those real estate updates, and thanks so much for watching.